All right, everyone. I think it's time for another market update. It's been quite a while. I think it's been, man, has it been like 3 months? 2 or 3 months at least since I did the last one? So, a lot has been going on in the market over the last 2 or 3 months. Some pretty incredible activity from just a volatility perspective, from a supply chain perspective, from what's ripping, what's collapsing. It's pretty nuts out there. I wanted to start with just the S&P 500, where we are year to date, and right now we're down about, I think we're down about 8% year to date. So about 8 or 9% year to date. If you look at the Nasdaq, I think we're down about 14, 15% year to date, something like that. Yeah, so 14%. So, pretty directional start of the year, to say the least, right? You start the year heading lower. There's been a couple of bounces along the way, but definitely heading lower. So we'll get to why we're at a little bit of a crossroads right now, where we're either going to rip to new all-time highs, or the market is going to absolutely tear itself apart like it's been trying to do for the better part of two plus years. So I want to start actually by going through what I call round trips. And round trips are all of the stocks that got a ton of attention coming, I think it was maybe April, May 2020, all the attention from the pandemic, right? It's oh my God, I'm gonna be locked in my house. I need Roku, I need Peloton, I need all these other things because I'm gonna be working from home. I'm gonna be working out at home. I'm gonna be being active at home. I'm gonna be watching way more TV at home. I'm gonna just be home more. And so to be home more, you need all the things that allow you to be home more, right? So let's run through some. Roku. Round tripped. So back to prices that we saw in April and June of 2020. It is down from its peak about 76%. We've talked about in the past, and I'm only going to do it with Roku, and you can just apply this to the rest of them that I talk to. This is a standard trend. You oscillate above and below that trend, but when you get this far away from it, a standard trend, no good comes of it. So even though, like, while you're up here and the stock price is moving a little bit and gyrating a little bit, and you're like, oh, I think it could go higher, I think it could go further, at any point here, you are taking a ton of risk, a massive amount of risk. This thing just went parabolic and you want more. So keep that in mind, because, all the Seeking Alpha, Motley Fool, CNBC, these are the type of stocks that get pumped and they get dumped on retail investors. PayPal. Good old PayPal. Back to prices that we haven't seen since April 2020. Full round trip. Penn. I love Penn. Don't need to tell you why, but I love Penn. Nice upward trajectory. Goes absolutely apeshit parabolic. Now, Penn looks a little bit different than its other casino counterparts. But you could tell, like, these casinos had their parabolic moments as well at some point. So that's Wynn, Las Vegas Sands, a little parabolic there. Pretty, looks a lot different than that Penn chart, right? What's the other one? MGM. So MGM's been acting the best so far. So Square, block, they call it now. Almost round tripped. Back at June 2020 prices, looks like it's coming back into, April, May prices of 2020. So another one round trip. Shop. Everybody loves Shop. Oh, everybody uses Shop. Can't go down. It is heading lower. So May 2020 is the last time we've seen these prices. DocuSign, I'm going to be home. I can't wet signature anything. I don't feel like buying a scanner or a printer. I'm going to DocuSign it. And May 2020 is the last time we've seen these prices. Ring, I don't know, is this the company? This is the company that is like the doorbell, right? I could be wrong. March 2020. Back down to those prices. Coop. Software. Yeah. That thing's all the way back. ESTC. Elastic. Software. All the way back. PAGS. Can't pronounce it, so not gonna try. All the way back down. APPN. Appian Corporation, all the way back down. That's another software company. STNE, Stoneco, that thing is destroyed. SPWR, that's solar, heading back lower, right? October 2020 prices. Peloton, ouch, oof, that looks painful. March, April 2020 prices. I think you guys get the point, right? So the main point here is that when I say that the market is tearing itself apart, it was already starting to happen pre-2020, but it's really starting to happen now. And so if you're not profitable, if you don't have free cash flow, if you're not going to be profitable in the next 1, 2, 3 years, you are getting discounted heavily. When I say heavily, you are losing 40, 50, 60, 70% of your value in stock price, okay? Why is that important? It's important because if the lower quality companies and stocks are getting discounted heavily right now, what that tells you is that it's only a matter of time until it starts making its way up the quality ladder. Let me show you some examples. The highest quality stock in the market is Apple. Why is it the highest quality stock? Highest amount of free cash flow, still growing, massive balance sheet. And we've talked about this in prior videos of how it looks like Microsoft from 1999, 2000, right? You know, the same kind of standard trend, starts a different trajectory, parabolic. And this move here is to be determined. Now in 1999, 2000, Microsoft had made a parabolic move, and then it came down. It tried to get back up to the high, and then that was it. That was it for 14 years. So a lot of people think Apple is different, and I'm going to show you why it has a good chance of breaking out to new all-time highs and going even more parabolic. And I'm going to just again, stick with the analog that, this could have possibly been the last high. So I'm going to give you the devil's advocate view on why it could go higher, which would be insane, but it could. So that's the highest quality. But let's look at something like, we're going to go down, let's do all the FAANG stocks, right? FAANG. So let's start with Facebook. So they had slowing user growth. I think they had lost users for the first time in history. And they are back down to April 2020 prices. Now, a lot of people thought that, listen, Facebook from a sales and profit perspective may be fine. But you start seeing cracks in user growth, that's going to be a problem for years to come. And so now Facebook's getting discounted pretty heavily. You could see that over the last couple of months. This thing's down 46%. I think it hit $1 trillion at some point at the high end. Maybe it didn't, but you're talking about hundreds of billions of dollars worth of market cap just disappearing. So we went through Apple. Let's look at Amazon. Now Amazon's an interesting one. From a technical perspective, this does not look good. Rejecting the middle of kind of a broadening pattern is never a good thing, but it doesn't necessarily mean it's going to break down out of it. What I will say though is this seemed a little bit more parabolic during this period, 2020, and then it just went sideways, and it's been going sideways. And we've talked about that in prior videos, how it just kind of stopped going up. It made incrementally higher high here, chilled out for a little bit, and now it came down. Now it's having a hard time getting back through that middle. It's going to be really interesting to see if again, when I bring up all the data on why the market could rip to new all-time highs, if these stocks are going to join in that movement. Netflix. Actually, I haven't looked at this chart in a while. Netflix is down 43% from the high. It tried to do what Amazon did, right? So it tried to make that kind of move in 2020, but it stalled out. And it went sideways just like Amazon did, but then it broke out to new all-time highs, and then that doesn't get recovered quickly. So you could see that FAANG, which very much in 2015, 16, 17, 18 was very much going up and patterning hand in hand, right? They would all go up together. They would form pretty much the same patterns, and then they would break out of those patterns, head higher together. And now what you're starting to see is that group of stocks decouple. And some of them are going sideways, some of them are going down. Apple is going up, right? Google, a little bit more like the Apple pattern, right? I what I would say is like this has been the most directional, because even Apple kind of paused out a little bit, but Google's just been an incredible move here. Now it's down a little bit from its all-time high, but I mean it's pretty close to the all-time high. If this thing goes sideways to down a little bit, it doesn't look like it's getting sold the same way that Facebook or Netflix is getting sold, even Amazon to a certain extent. So this is acting pretty well as of now. It's again going to be pretty interesting to see how it develops. I don't love where it's at right now. Again, if this thing doesn't catch some buyers soon, this thing could easily go lower before it goes higher. So that's FAANG. So those are all your highest quality, and some of them are starting to break up a little bit. So you're starting to see the names that always went up together decouple. You're starting to see the ones, like Netflix, for instance. Netflix has a ton of debt, right? Netflix has a ton of debt because they have to pay a ton of money for content, and they are not as high quality as an Apple. And you could see how that looks from how the prices are reacting, right? So that's where we're at with FAANG. That's where we're at with the market. The market is not down that much, 8-9% from the highs. The Q's down 14% from the highs. But what I really want you to see is how the sectors have been performing. What you see here is year-to-date performance across baskets of stocks, ETFs. So the ones that I picked are regionals, home builders, airlines, metals and mining. I should probably add retail in there. REITs, biotech, oil, gas, agriculture, oil services, software. So really, I wanted to show you the growth, how the growth has been doing year to date, and how the value's been doing year to date. And so, as you can see, the S&P year to date is down about 8.58%. And the best performer out of the ones that I've chosen is this one, oil services, up about 30% year to date. Large cap energy. Well, it's more like it's heavily weighted large cap, but it's not just large cap. But that's up 22.61%. Oil and gas E&P, 13.12%. Metals and mining, 10.32%. Jets, airlines, 6.97%. I want to have a little side convo about jets in a little bit too. I wish I could add EWZ in this, which is Brazil, which I've been using a lot. But so you can see those have been outperforming heavily because it's not just that OIH is up 30%. It's that the S&P is down while it's up 30%. It's one thing if the S&P was up 30 and that was up 30, right? Zero spread, right? It's just, okay. Oil services just tracks the market. No. This is what I mean by we're literally tearing the market in half. You are pulling apart companies that are going to be profitable, that are paying down debt, that have free cash flow, that pay a dividend. You're pulling those apart from the ones that don't. And this is what it looks like. Now, some of these, like ITB, now that's home builders. ITB has been on an incredible run. This is a very, very strong run out of the pandemic, and that mainly was because of all of the demand for houses. Again, if you recall, rates bottomed out, and people wanted to get the heck out of the cities, and so that was seen as like a boon for home builders, home construction. So you gotta understand that, okay, fine, maybe it was good for home builders, and now you talk to a lot of builders out there, they have 2, 3, 4 years worth of work ahead of them. That's how much demand is out there, that they're backlogged not by months but by years. Mainly because of supply issues, also because of labor issues, but we could get into that on a side combo. But the main point is the demand. Massive amounts of demand is coming in and they can't meet it. And so if they can't meet it, they could charge higher prices, because if you want your house built quicker, you're going to get charged a little bit more to have that done. So home builders have done extremely well, but it's time for them to kind of level out a little bit. Home builders are extremely undervalued. You're talking about forward PE ratios under 10, in some cases under 5. So you're talking about companies that make plenty of money. Some of them pay dividends. And this is a very good area to be invested in, especially that you're getting about an 18% discount this year, right? So if it comes in a little bit more, it's not a bad thing. It's a good thing. This broke out. The reason why you see this line here is that May 2006 was where they started. It took them 14 plus years to break out. So just keep that in mind. You just broke out of a 14-year bear market in home construction and builders. So even if this comes back in, this has a long runway to keep trending. Biotech's been getting crushed this year. Software's been getting crushed. Real estate has been getting kind of crushed. Retail kind of crushed. So here's technology. Now, technology, software, a little different from each other, but also down 12.33%. REITs down, healthcare down, S&P down, and we don't need to go through the rest. At materials, the XLB is actually down, which is really interesting. If you look at the components of the XLB, they really categorize materials. Like, materials versus metals and mining are two totally different things. We're not gonna spend the time to go through that, but materials are actually down this year so far, but metals and mining are up. So very interesting to see that. Regionals are kind of sideways, financials kind of sideways, agriculture kind of sideways. So this is the market pulling itself apart, and I think it would be good for you to see what this looks like on a 10-year and on a 5-year. So look, on a 10-year, so to put this in perspective, we're about 50 days through 2022, and I'm showing you how much some areas of the market are up versus other areas of the market are down. But in the grand scheme of things, when you're a long-term investor, when you have 10, 15, 20, 25 years, 30 years ahead of you of investing like many of us do, in the grand scheme of things, it is absolutely nothing. It almost doesn't matter. You can make the case that this is a blip, that this doesn't mean anything, that it shouldn't be, you shouldn't look at it like it's anything, like that's it, right? Like, hey, or okay, value had a really good start to the year, but whoop-de-doo, I'm long technology for the last 10 years. So tech is obviously the best performer over the last 10 years. Software, another huge winner. Home builders, another huge winner. Now that's, again, keep that in mind, that's only since 10 years, so 2012. That's why home builders are up there. XLV, which is healthcare, up big. Financials, the S&P itself, up almost 300%. And you could see some of the names that are pulling itself apart right now. You have, this is the top year to date. This is a top year to date. This is up there year to date, up there year to date, up there year to date. So in the grand scheme of things, what's been happening over the last 50 days means nothing, right? If you've been long for the last 10 years, this is absolutely just a blip to you. But most people aren't. You got to remember, most people are. But what happened during COVID was you had a very, very quick everybody go into cash moment. And so there were a lot of long-term positions that got liquidated into that February, March 2020 event. So keep that in mind. If you have positions since March 2020, well, you're having a little bit of a different experience. Okay? This is only a year. I wish there was a custom. There is not. 3 years, because 3 years is still going to show that. But this area right here, there's your March 2020 bottom. And you can see, again, technology is actually leading since the bottom. Home builders leading since the bottom. But look at what's creeping up. You have materials creeping up. Metals creeping up, materials creeping up. All the things that we really look at. But look at what's lagged, right? Jets and OIH. So why does it matter? The conversation around airlines, people seem to be very afraid of airlines for some reason. What this shows you is nobody's going to fly a plane ever again. Nobody's going to travel ever again. You stay home. You don't go anywhere. Airlines all go bankrupt. That is what this had priced in. Okay? So if this is pricing in the worst case scenario, you got a 62% discount on the worst case scenario. End of the world type stuff, right? Like never going to travel, everybody stay home, that's it. 62%. I've been having conversations with people lately, and they're like, well, it's still a pandemic. People, still nervous. Not going to travel. You crazy? This countries are still closed. Countries still have mandates. You still got vaccine passports, all that stuff, right? A lot of that stuff is coming off. Little by little, it's coming off. Little by little. And if this is your worst case scenario, and people have spent all this money because they have all this extra money, you got to remember, if you owned assets through the pandemic, you are richer today than you were pre-pandemic. Zero, that's not a discussion. The market is higher than it was January 2020. Your house value is worth more. People have a lot of cash. And no, this may not translate through all demographics. This may not translate through all tiers of the equity classes, right? But you got to understand that people who had assets have more money, and now they can spend more money. So if they want to start traveling again because they've taken the last 2 or 3 years off from traveling, well, you're in a really, really good position here because you're at the same price you were at in early March 2020, right? So if people are going to be traveling more going forward, or they have more money to travel, and maybe they're going to be traveling instead of there's really just a ton of pent up demand. If you had all these vacations planned, all these bucket list items that you wanted to get done, and you couldn't for the last 2 years, what do you think you're going to do now? Especially if you have more money. You're going to go do them. And that's very, very good for airlines. So I think worst case scenario was priced in. Obviously, it's not as bad as, it's not as bad now as it was 2 years ago. I think there's only going to be up for airlines from here. So, maybe it comes back in one more time. Who knows? Maybe it even touches 18. But airlines, I think, are in an extremely good position. You also have to remember, too, and this is going to take some time, but a lot of these airlines used to pay dividends, and now they don't. So when the dividends kick back on, then they can start getting included in funds again. UAL never did. What's the other ones? ALK paid a dividend. That's Alaska. I think Save and Frontier just joined together. Delta Airlines used to pay dividends. So a lot of these companies haven't even kicked their dividends back on. And look, they may not kick their dividends on for another year or two. But the point is that when they do, that's going to be a huge boon for these stocks. So keep that in mind. That's a really good conversation to have around airlines, because I think a lot of people are still very much worried about where the direction of the airlines. And listen, put all the political stuff aside about them getting bailed out and whatever, which obviously is BS, and it's absolutely absurd that they needed a bailout. You can't have government get involved in capitalism too often, because the whole point of capitalism is failure. It's you're supposed to fail so something can be born anew from it. And so the fact that we keep saving these companies from their demise is absolute BS. People need to go through pain. It's like we keep stopping pain from happening. Like, you need pain to happen. And that's the only way things get better. Like, things don't get better by just letting a bad company continue to be a bad company, right? And yes, it sucks for the pilots. It sucks for the stewardess. It sucks for everybody involved in the industry. But that's capitalism. That literally needs to happen. And we keep stopping that from happening, and it's not good. That's my rant. Okay. So, what else did I want to show you? Oh, all right. So why are we going to rally? Why is there a chance to rally back to new all-time highs? Let's give it a look. So here's your S&P. And I want to show you a couple of times that the S&P has gone. Don't worry about back there. Let's look at this 2015 through 2017 period. So let's see what I got here. One of these things. This period right here. Let's take a little bit of a closer look. So you're having a pretty strong market in 2013. I think it was almost every single month was up in 2013. You come into 2014, you start getting a little bit more of a dip, and now you're leveling off. 2015 to 2016, your market was sideways with two pretty strong dips, and then we went back off to the races. Why is that important? It's important to know that when a market trends, it goes sideways after. Now, 2016, 2017 was a really good run, and then you went sideways in a much more violent fashion. You had 2018, which you had a very quick 10% dip. You had the back half of 2018, which you had a very quick 20% dip. And then you had the massive move here that happened because of the pandemic. But if you just draw a line across, you pretty much went sideways, right? So then now you've had a couple year trend. So just like if you were to take the bottom of February 2016, extend it to January 2018, that same thing has happened, obviously in a little bit more dramatic fashion. And so now what is going to happen? You can use this historical idea right here and apply it to now and say, okay, well, maybe we have a year and a half, 2 years worth of sideways action to come. It's why I've been saying, especially I've been telling clients, like, look, hey, the market could go down to sideways the next 2 years. Don't be surprised, especially if names like Facebook get decapitated like that. If Netflix is going to get decapitated like that, then yeah, we can absolutely go down to sideways the next 2 years. But on the flip side of that, we've had some three really important points here. This is the AII sentiment survey. This is a little bit like the old man survey, old investor survey. I don't think a lot of young kids take this survey, but you're at 19% bullish, 43% bearish, and the neutral and the bearish doesn't really mean anything as much as the 19.2% bullish. This doesn't happen often, ladies and gentlemen. And when I say this doesn't happen often, like this happens maybe once every 5 years. So the fact that this just happened while the market's only down, the S&P's not even down 10%, it tells you something. It tells you where investors' minds are at right now, and everybody's looking down. You could actually even see a few weeks ago, bears were at 52.9%, which that's another one of those extremes. So, and we're not down much. We're not, it's not like this is February, March 2020 where the market is going down 10% a day. You're looking at 1 or 2% moves in the market, and people looking straight down right now. So that's a really important point. We haven't seen that in a very long time. What's the other one here? So put to call ratio. So this one is more of a day-to-day kind of thing. But what this means is puts is people betting down, calls are people betting up. Let's just simplify it like that. We don't need to get into all the other stuff regarding options. But the point is that over the last 2.5 months-ish, people are betting down more and more. So you could see we're in a little bit of an uptrend here. And this isn't like a stock. This is a ratio. So you have to understand that it's always going to gyrate within a range. But what's really important to note is that we're in an uptrend of the put-to-call ratio, which means more and more people are looking down than ever before. You had a couple of pretty high notes. Almost 1.4 there. So that's really important to know that your highs are getting higher, your lows are getting higher. That's an uptrend in the put to call. So more puts than calls, more people betting down than betting up. And so that's what that means. So that's really interesting to keep in mind right now, because that normally doesn't happen. That doesn't happen at tops, right? It goes the other way at tops. Everybody bets up and then a top is formed. Right now, this is kind of signaling that even though we're only down not even 10%, we're kind of looking, this is like a short-term bottom in the market. How hard we bounce is yet to be seen, but one of the things you want to know is how much ammo investors have out there. This is the Global Fund Manager Survey, average cash balance. Now, this is an old one, but I want to show you the old one before I show you the new one to give you some reference. We talked about 2015 through 2016 being sideways. You could see that coming into 2015, 2016, your cash wasn't low, absolutely not extreme low. It was just lower, right? So you're having this really nice, smooth uptrend, and then you kind of top out a little bit. And what happens during that topping out period is everybody's looking lower. As everybody's looking lower, they're putting more cash on in their funds. So their funds have more and more cash, and you have massive cash balance here, and then you go back off to the races for 2+ years. So it's really, really interesting to see that, so you understand that cash is raised during the down move, during the sideways movement, not on the way up, right? So you could see 2003 to 2008, cash was not getting back up to those levels. You had this really low moment, which essentially almost topped it. It was the next high that topped it, but you have this right here, super low cash levels. Everybody was in. When everybody's in the boat or on one side of the boat, well, the boat tips over and you head lower, and that's what had happened there. So you could see other moments when it gets really low, you get these big gyrations in the market. So just keep that in mind when I show you this next one. So we look back at that move in now it's funny because they change where they put these red lines, but don't worry about that for now. 2015 through 2017, you have these a long period of cash balances above 5%, which is high, which is considered high. And we're back above that 5% level right now. So we've barely came down, and we have a ton of cash on the sidelines. Now, it's going to be interesting to monitor this, because if we go through an extended period of cash on the sidelines, then the market could, again, just go down and gyrate, right? It could go down to sideways, just like this period of time here. So just keep that in mind. The market doesn't crash with this much cash on the sideline, ever. Ever, ever, ever. It doesn't crash, right? So look at, like, coming into the pandemic. Cash got really low, crash. When cash is really low, then you go through kind of like a crash period. Now, you could look at this over here and say, well, okay, well, the market didn't crash, but cash levels were pretty low. Well, you were just coming off of one of the most, like, dramatic 35% drops in the market that happened over like a 3-month stretch. So, sometimes you got to put that into context. Also, they hadn't moved these lines, which I think is kind of hilarious. If you look at where the lines are here, 3.5, 4.5, 5 and 4. Don't ask me why they changed the lines. Maybe it's just to trick everybody, but that's something also to know. I don't know why they did that. Maybe it's just because it's a different time range, but. Another thing really interesting, tech net allocation fell to the lowest level since August of 2006. What that means is people are less overweight technology than they've ever been. Well, not since they've ever been, but since, like they said, 2006. But you could look at December 2008. Look how long tech was overweight, which is just insane. So there's been a lot of time spent overweight in technology. If you look back at 2002 to 2006, a lot of time, well, let's just say not a lot, but like less time spent being overweight technology during that period. So interesting to keep note on that. Crude oil, this is actually not a great chart, but I couldn't find the good ones that I was looking for. But the point is that oil inventories continue to go lower. We've had this discussion before. If the government wants to stop the production, stop reinvestment in fossil fuel production, well, this is what you're going to get. You're going to get supply down, demand up. That creates prices up. If you look at crude, I don't think we looked at any commodities this session, but take a look at crude. You are way up, right? So back above 90. We spent almost 2 weeks above 90. Pretty incredible. Pretty freaking incredible. We haven't seen these prices since 2014 in crude oil. We've talked about in the past how crude oil is an input for just about everything. Oil is an input for gas, input for agriculture. You can't get yield out of crops without all the equipment that it takes to do it. So that equipment is run by gas, and oil is a part of gas. So it really is, it's just a part of everything. It's an input for everything. You cannot run businesses, you cannot run industry without fossil fuels. We are not at the point of the transition that renewable and solar and wind energies have been able to meet the capacity needs that we need. And so oil keeps going up because we're going to need more of it. There's more demand, and supply continues to lag. So keep an eye on this, because one of the big conversations is really about, okay, well, oil is back up to 2014 prices, but then how about some of the stocks? Are some of the stocks back up to 2014 prices? And you look at ExxonMobil. ExxonMobil topped out at $100+ a share when oil. Let's just go back so I get my facts straight here. So 2014. So it wasn't. So your top was in 2008, but you kind of went sideways around $100 a barrel for 3 years. Let's draw a little line right there just to keep that in mind. So 3 years you were oscillating around $100 a barrel. So we're back up around 90 plus a barrel. And last time oil was 90 a barrel in 2014. Exxon was 104. That is another $23 above where it is right now. You look at like a Chevron, compare it to its 2014 price. Chevron's one of the few names that look at that. It has taken out its 2014 prices. You look at something like a Schlumberger, not even close. You look at like Occidental Petroleum, not even close. I think you can start to get the picture here. You know, you look at like Transocean. 2014 is somewhere around here, right? So not even within the ballpark. You know, you're 1/10 the price that you were in 2014. If you look at something like a MRO, Marathon, 2014 is 41. You're at 21. If you look at CLR, 2014 you're at 80. You're currently at 52. Now look, this doesn't mean that we're going to go straight up from here. You don't just achieve 2014 prices because the price of oil is where it is. The point is that just the last time these companies have maybe been that profitable because oil prices were so high, well, like they're not near those prices anymore. So it's going to be really interesting to see, because they've had a really nice run. You know, do they go sideways for a little bit, or do they just go ahead and start achieving those higher prices? This looks like a long-term time frame, but it's not. And I wanna stress just how important it is to be involved at these prices, even though it had such an incredible run. A lot of these energy companies up 300, 400, 500, 600%, or even like an aluminum name like Alcoa, which is up like 1,000%. But just I have to put it into the Apple perspective, because there's a massive difference between comparing oil and gas companies and metals companies to Apple, and there's a huge problem comparing it like I'm about to compare it. Like, Apple is a part of everybody's lives. It's not a cyclical company. It's you want a new phone, you get a new phone. That new phone costs $1,100 today. It's going to cost $1,500 in 2 or 3 years. It's going to cost $1,600, $1,700, $1,800 in the future. That phone's going to cost more. It's not cyclical. We're going to keep updating our phones. Apple could keep penetrating market share. So it's not a great comparison in terms of type of company, from obviously what they do, but also from kind of the category, right? You know, Apple's in a completely different category. But the point I want to make here is that you have the opportunity to buy these companies like right here, right? So not at their bottoms. That was your March 2020 moment, right? But somewhere here or somewhere here. So you have the opportunity to get in still very, very early in the process of these companies and these stocks achieving this move. And again, just in case you like wait, but they're just metals and mining companies, Kyle. They can't achieve that move. Well, they have, right? This is 2001, 2002, going into the top in 2008. You know, you're talking about a 6,000% move. So it's not like these companies can't do it, right? If I were to look back at ExxonMobil, 2002, 2003 to the top, 200%. So these companies have been, it's not like they can't make hundreds of percent moves, okay? So just keep that in mind when thinking about the potential. And obviously like the March, the low in March and November of 2020, I mean, you're already up, 130, 140%. But the important thing to understand is that you haven't taken out these prices yet, and you will. It's only a matter of time. So, yeah. So that is it. That's the update. I want to stress how important it is right now to look at your 401ks. A lot of 401ks have these passive funds in it. If you have the option in your 401ks to to move, to get out of the riskier names. Just again, like technology's been getting hammered this year. So you have trillions of dollars of stimulus, you have inflation running rampant, you have wage growth increasing. If a company is not profitable and things are getting more expensive to accomplish, that's going to be really not good for those companies. If a company has a ton of debt, they're not going to be able to keep refinancing it at lower rates. That's a problem. If companies rely too much, like even Apple, if companies rely too much. Now Apple's done a great job of vertically integrating their supply chain, but the point is that if it becomes more expensive to build technology, if the rare earth metals keep going up, like it's going to get more expensive for these companies in the future. And so you don't want a part of those companies. You want to be a part of the companies that can either transfer the costs very easily onto the customers and clients, or the ones that actually produce. So those are kind of the two things you want to keep in mind during this period. Is are they able to just, it's more expensive for me, then it's going to be more expensive for my customers, or I was running my company selling barrels of oil for $40 a barrel, now I can sell it for 80 or 90, right? So you have to just keep all those things in mind over the next. I'm going to try to get back to doing these monthly, but over the next months, over the next years, these things are really, really, you want to keep in mind because this is still a huge opportunity to get in early on a lot of the shifts, on a lot of the transitions in the stock market. So hope everybody enjoyed it. Hope it was educational for everybody. Again, just reach out if you want to talk about any of this stuff. If you need any advice on anything, you can call me, text me, email me, whatever you want to do. All right, take care, everyone.